Welcome to session 5A, the only thing between you and champagne. My name is Lori Fitch. I'm a partner at PJT Partners. We are an advisory-led investment bank. We focus mostly on advice and not financing, despite the title of this panel. But financing is, of course, critically important to our clients and to our deals. And so I know a little bit about financing. I focus on the utility sector globally and also on industrial manufacturers, mostly power equipment, all of which has been talked about quite a bit today. The title of this panel is Financing the Energy Transition, Evolving Norms, Risk Conceptions, Treatment of Market-Exposed Revenues. It's a very academic title. I just want to make 2 points. The first is the sector has been in transition for over 100 years. Certainly for the 20 years I've been following it, and definitely now. It does seem, of course, that we are in the midst, as Matthias mentioned, of a real revolution, though. And the consensus, of course, is that energy markets of the future will look very different from today. Can only say with certainty that the past is much easier to predict than the future. The second point I want to make is something that got bantied about a little bit at the last panel, which is this concept of subsidy-free or market-exposed revenues, which is in the title. I think we are at a critical juncture because we talk about merchant sometimes as if it's a bad thing. Merchant is not, of course, inherently bad. It's how most business gets done. It's just not how this sector has done business for a long time. And so that's something I think we will tackle today. This panel has one of everything almost, including a lineup change. James Samworth at the end of the row, pinch hit for someone who couldn't make it last night. So if you're trying to match up the picture, it will not match up. Yeah, much better looking, yes, thank you, George. But it has some voices that haven't been heard yet today. It has solar, we have flexible gas, we have biomass, we have waste to energy, we have big oil is a voice that hasn't been often heard in utilities forums, but one that I think we expect to hear more from in the future. And with that, I'm going to ask them to introduce themselves. And when they get done with introducing themselves, I will start with a few questions, but I want this panel to be much more interactive audience participation than I think some of the other panels have been. So I encourage you all to get your questions in early and often, and we will keep it going as best we can. Thanks very much, George. Maybe you can start.
Thanks, Laurie. George Grant, one of the founders of Stag Energy. We've been focused in the sort of peaking power sector in the UK for the last 5 or 6 years. Just by way of background before that, I mean, I've pretty much spent 3 decades in the power sector since the advent of sort of privatization around the world, and the independent power sector began in the US with IPPs, and those began with long-term PPAs that everybody got comfortable financing, and then came over to Europe, similarly CCGTs, long-term PPAs, and we gradually, over a period of years, got comfortable with moving to merchant financing in the kind of late 90s, early 2000s. Then spent some time in Asia. China, Philippines were multilateral finance on the basis of, again, long-term PPAs. Australia, where we did a few sort of merchant financings. And then back to Europe, where I think we all acknowledge the majority of recent investment has been on the back of long-term, low-carbon contracts with government backing. And I think a lot of the discussion today, we're getting to a point where there's a lot of talk about subsidy-free renewables or low-carbon generation. What does this mean? How do we get that long-term investment in infrastructure assets in this emerging environment? We need, generally, for the financiers in the room, stability and predictability. How are we going to get there?
I'm Pratima Rangajaran. I'm the CEO of OCGI Climate Investments. Now, prior to this, I spent over 10 years in wind and in energy storage. I worked for some OEMs, Vestas, GE, developing and delivering these products. And so it's interesting as you look at low carbon from both sides, the renewable side, as well as now in the oil and gas sector to lower the greenhouse gas footprint. Some of these questions about how do you finance this, how do you actually scale, and how fast can you scale if it was purely market-driven versus having the business case certainty of a regulatory-driven regimes. Because it's not different. However you try to get to low carbon technologies, whether you do it on the renewable side, or the oil and gas side, or the industrial side, they all require the three pieces, which is really technology, they require economics and scale. And economics always has two parts. There's a market piece and there's a regulatory piece in our sector. And so the lessons learned are very relatable.
I'm Matt Setchell. I head up Octopus Energy Investments. We manage on behalf of our investors about 2.7 billion pounds of energy assets, including a very large solar portfolio, onshore wind, biomass, landfill gas. We've got about 400 megawatts of gas recips as well. Recently, we've been expanding out of the UK into unsubsidized, purely 100% merchant in Italy. We've got a portfolio in France and looking further afield in Australia. Under my mandate as well, we've got a strategic investment in a company called Reactive Technologies. Reactive is a technology company that coordinates between our generation assets, demand and storage. We've also got a retail supply business that sits outside of my mandate, and therefore I'll sidestep questions on energy price cap as I appear to be in the minority in the room here.
Good afternoon. My name is James Samworth. I'm a partner at Foresight Group. We're investors in infrastructure and private equity aspects of renewable energy and related sectors. It is rare to be on a panel sat with someone who owns more solar than we do. I think we're number 3 in Europe, but Matt has a large portfolio. We also have a reasonably significant energy from waste and biomass portfolio, which is my particular area. We're also very interested in and active in, I guess, broadly the markets for flexibility, the subject of much discussion today. So we own 2 utility-scale batteries with EFR contracts from last year. We have a reserve power fleet of gas recip engines. We have a smart meter portfolio and exploring many others. So I guess we are interested in the continued growth and market share growth of conventional renewables and renewable generation, but also increasingly interested in all the things that go around that and make the next phase of that growth possible or unlock some of the barriers.
Thanks very much. I promised Matt that I would put him on the spot first, which is, and I will. We spent a lot of time today looking at charts that show the threat and the changes brought about by merchant solar, but we haven't really heard from the merchant solar or the solar industry, period, really. And that, I would say, you represent. How has the financing evolved for these projects? And do we need to rethink the risks and the cost of capital in a market without subsidies? I note that Octopus is investing in merchant solar in Italy, I believe. Is that correct?
I mean, so just stepping back, our investors in ROC subsidized assets are taking merchant solar risk. 50-60% of your revenues have got merchant risk. Most of the conversations, the first questions, the investors, whether it's Koreans, Malaysians, Canadians, UK pension funds, or Australians, they're going to ask you about merchant power price exposure within that ROC subsidized business. And then if you layer on top leverage on top of that, effectively those investors are taking 100% merchant risk. So you can build up a picture of what type of merchant risk people are prepared to take, and the type of cost of capital could be applied to that, either from what a levered solar return looks like, I don't know, 8%, which is pretty much 100% merchant risk, or you can build it up from cost of capital on your ROC, your government subsidy, plus a bit of operational solar risk at whatever 3-4%, and what spits out the other side is your merchant solar risk. So in pure sort of analytical and a perfectly fine sort of logical flow, you can come up with a cost of capital on solar that people today are implicitly taking when they're investing in ROC subsidised assets. And by the way, there's not a shortage of demand for those assets in the UK from long-term owners of those assets. However, to be honest, I'm a cynic that just because you then take out all the ROCs and you're left with the 8%, 100% merchant, then those same investors are going to come in. Clearly, we heard a really good presentation earlier today from Matthias, and he pointed out quite rightly the uncertainty within that in that merchant risk. Our view is it could go one of two ways. To Laurie's point, some investors are going to be happy with that merchant exposure, and in due course they might get educated, and managers such as ourselves or other owners of these assets will demonstrate how we can manage the risk to those investors. Actually, we've got a view that it's better to move those investors into these assets on the basis that a product that's really attractive for those type of investors is a kind of a fixed income plus type product. So our aim is to be commercializing these assets, taking out the construction, taking out the development, getting onto a platform that is well managed, but then move to a point where you can take out some of those merchant risk exposures. And we think that's where a mass rollout of renewables can happen, because this is where actually if you can offer long-term corporate PPAs, you can turn a solar asset into a bond, and you're effectively replacing your ROC subsidy with a corporate credit risk. That could be really interesting. Now, I sat in here listening to the last session where the idea that we're going to be able to achieve sort of corporate PPAs at any scale was questioned. We're giving it a go. Actually, we think there's potentially different ways of doing this. The traditional approach for corporate PPAs being 60, 70-page sleeve arrangements, tripartite agreement, heavily complicated, an 18-month negotiation process. Actually, if you can do a CFD derivative product that's 6 pages plus a few pages of appendices, and you can still attach your regos or equivalents with that, you get a quite different product and an interesting product for those corporates. If you then innovate again and start thinking about ways we can use our technology, so rather than explain to a corporate that they're going to take all the balancing risk, actually explain that we can sell you a green block PPA, then you might not have to be competing directly on price, but you might be able to sell, big supermarket chain that's just been committed to buying 100% green electricity by 2020 or 2025, that actually they can buy blocks of those power in the way they're used to buying it. And that's only possible with very large portfolios by having technology that, through reactive technology, that enables us to manage the shape risk on the edges of that solar portfolio. And indeed, we'll be combining that with wind as well. So there's a natural sort of portfolio effect there.
So Matt, you mentioned an 8% cost of capital. I assume that's with the de-risking wrap.
Well, I think this is my point, is that if you do the logical flow that says if ROCs plus operational solar is 3%, and people in the market today are buying unlevered solar at somewhere between 6 or 7%, then what spits out the other side is a 8% 100% merchant risk. So implicit in the current market price for solar assets is a cost of capital on merchant that's 8%. Or the other way, as I say, is actually people are prepared to buy levered solar, and their equity return is entirely merchant risk, effectively. And then that's coming out of the same sort of price, 8 to 9%. So my point is that the buyers of ROC assets today are taking that merchant risk at that type of cost of capital. Whether the fact that it's blended together means that they kind of get themselves comfortable, my instinct is probably, which is why rather than just say, well, it's okay to accept 80% when it's 50% ROC, actually we're going to try and de-risk those assets down.
Okay, but if there were zero subsidies, zero ROC on that, exactly. Assuming it would be much higher.
Well, the maths says it shouldn't be. We're saying that the demand for these assets, I'm suggesting, are probably not going to be there for your pension fund investors at 8%. Yeah. So I think I'm agreeing with you. But the logic would say that actually they're taking 8% risk. I don't think you're going to get mass scale of renewables at 8% with merchant risk. That's probably stating the obvious, which is why we need to start de-risking that with the likes of corporate PPAs.
So Matthias obviously was listening to you because his sort of presentation, which was a very good one, earlier on today, in looking at subsidy-free renewables in a merchant marketplace, was looking at 8 or 9% cost of capital. And if you bump that up, I think, I don't know if Mateus is in the room, but to 13%, then you get a few CCGTs by 2030, which is probably, well, clearly what SSE was looking to hear this morning, but don't know that we're going to see very many of them. But the cost of the capital is a huge driver as to what's going to get built.
Well, maybe that's a nice segue to a topic we haven't addressed yet today, which is interest rates, which are obviously an important component of the cost of capital. Obviously, Mateus's delta was quite wide, and we've been enjoying an unprecedented period of low interest rates. But how do you at Stag look at sort of rising, the potential for rising interest rates, rising cost of capital, and the impact on your business? Or can you de-risk it, as Matt says?
I mean, in some respects, we kind of have to roll with the punches as to where interest rates are going. But we are looking at a sector where we see a demand for flexibility in a lot of the products or assets that we're bringing forward. You have to be delivering low cost, both from a development and a capital cost, and then you do what you can in the marketplace at the time for capital. And you're, I guess, assuming that everyone else is playing in the same sandbox, so to speak. So I think there is a concern as to where interest rates are going. We have enjoyed a very long period of low interest rates. But it's not really having a kind of material impact on what we're focusing on at the moment.
And James, you obviously operate in a very heavily subsidized part of the sector.
Yeah, in some respects, yes. Yeah.
How do you think about interest rate rises, I guess, in the context of the financeability of your business,
Yeah.
and how do your investors
Yeah.
think about it?
I guess in some respects, the fact that this is a relevant conversation is a sign of success in some respects, because when people are looking for returns comfortably in the double digits, then the spread over base rates is much less relevant. As yields have come down, that has got a more relevant discussion. In the energy from waste and biomass deals that we do, things would have to move a fair way, I guess, if we're financing stuff in the double digits. But in solar or onshore wind, clearly it's not impossible that starts to become relevant. I think it will probably drive an increased sophistication of the analysis. So I think people will give sort of hand-wavy answers about correlations between interest rates and power prices and so on and so forth. But is that really going to stand scrutiny without doing the kind of equivalent of Mateus's analysis earlier from Aurora or other market research firms of whom I'm sure there are many. Sorry, John. I think it has to play into the pricing, but I think to an extent George is right. That is a relatively transparent market. Nothing we do is going to move yield curves. So fundamentally you have to take a read of the market at the time.
Matt, do you think the cost of technology can compete or outpace the interest rate curve in solar? Yeah, I mean that's.
Does it need to compete or outpace the interest rate curve? So I think picking up some of James's points is that if we assume that the return on these assets are all got a heavy inflation linkage, what we've done from an analysis is actually clearly you've got a bit of a dirty hedge in there with inflation going up, which is obviously hand in hand with interest rates going up. You've also got a view that actually the spread between your bond yields or whatever measurement you're doing and your risk capital and sort of operational solar and wind will narrow as interest rates go up, which has been demonstrated through different cycles. Now, clearly you've got to see how it plays out, but that's our view at the moment.
I'm going to ask one more question before I open it up to the audience. Pratima, we haven't heard from you. We talked, or someone spoke earlier about the role of doing small things, incremental things within the overall context of lowering, within the overall context of industrial policy, and that these small things, the role of the small things doesn't make a difference, or are they just too incremental to move the needle on the whole? And when I look at the portfolio of OCGI, you are clearly working, it seems, within the sort of envelope of existing technologies to make them less carbon intensive. Is that fair to say?
I think the outcome is to work to get the existing technologies to lower carbon footprint, but the effect of that actually is a larger lever than you think. I moved over from renewables into the oil and gas sector because I actually think there's a larger lever to lower our carbon footprint and to get to 2 degrees C on the oil and gas side than there is if I continue to work on renewables. And simply because 30 years ago, 80% of our energy was from fossil fuels. Any guesses as to what it is today? That's 80%, right? And because the demand has grown so much that both the energy efficiency as well as the plays from renewables have been absorbed. And this continues. And so oil and gas is going to stay a substantial part of our future. So in order to actually make a big difference to 2 degrees C and to our greenhouse gas footprint, we have to work on this. I don't think it's small and I don't think it's incremental because it is the largest chunk, right? I mean, the analogy I drew, when I was trying to explain this to my kids, right, was I was working on the chocolate chip. Now I'm going to work on the rest of the cookie. So I think it's a big deal, and it's no different to me, having worked on both sides. Lower carbon footprint is lower carbon footprint. However we get to it, I don't think we have the luxury of picking and choosing. So I think they're all relevant.
I posed that question to Pratima on the phone. I said, do you think you're doing enough? Is the industry doing enough? And she rightly shot back, well, how did you get to work today? And do you fly? Which is to say, how much are you doing personally for?
Yeah, and I think we've gone to a point where we keep talking about supply. Yeah. The fact is, supply is only there to meet demand. And the demand is what is increasing substantively. And I do, and as I sit and try to work the numbers out and think about it really, and again, I'm a mother. I think about it from my kids' and grandkids' perspective, right? I think that we actually can't get our arms around it unless we work on the demand side as well. Because again, watching my 10-year progression in renewables and watching energy efficiency impact of all the work you all do with reactive and other pieces, it gets absorbed if demand keeps going up at the rate it's currently. So I think it's just a matter of working both sides like we always do in market-based economies, right?
It's now that I will ask anyone out there who has a question to please raise their hand, and we will get the microphones ready. Must be something. Also, if you would like to direct it to someone, please do in particular. If not, we'll direct amongst ourselves.
Sorry, Suzanne Stephanie from PJT. We heard earlier about a lot of the disruptive technologies, such as demand response or blockchain. Where do you think those belong, and do you invest in those, or do you take those into consideration as you think about where you're moving forward?
Matt?
I can pick that up. So off our own balance sheet, we've invested in a company that is a demand-side response company called Reactive Technologies. So they kind of do a bit of everything. So they've got some fantastic grid technology, which measures inertia in the grid. They've got a demand-side response, so turning fridge freezers up in car 4. And they've got a forecasting technology that we're using now on our generation assets. So I see sort of that type of technology being the sort of the enhancer for lots of different parts of the business, frankly. So On our generation side, it means we can get a sort of a differentiated risk return on our wind and solar assets because we might be able to negotiate slightly better sort of offtake because we've got better forecasting technology on there. We can look at doing some incremental returns on the solar assets. I was interested to see the sort of revenue stack earlier for offshore wind. Actually, we're looking into how we can generate a revenue from our solar assets at night using our inverters to do the phasing on the grid, which I don't understand the electricity engineering side of it, but it sounds really clever. Never expected when we first invested into solar that we'd be commercializing stuff at nighttime. But this type of technology that opens up lots of new angles enables us to give something slightly different to our investors on that side, but also means we can offer different types of products to our corporate customers. So, as I've sort of mentioned earlier, one of the key risks of the mass scale out is being able to de-risk the energy price. And we've got what we hope is a perfect storm where you've got a shift from subsidized supply leading the rollout of renewables to consumer demand. And these corporates are going to start being the minimum floor, is that they're going to have to 100% renewables. So green power becomes really valuable for these renewables. And being able to deliver green power to them in a way that they're actually used to buying it with the likes of reactive technologies, we hope is going to give us a foot into the door.
If I could add to that, I think the power sector utilization factors, the grids across the world are extremely poor. In the United States, for example, the grid utilization factor is 45%, between 40 and 45%. So there's a lot of unused assets across the board. And so these kinds of technologies now using both the digital and the ability to do, not a push out, but relate different pieces of energy supply and demand that we're talking about here is going to have an enormous impact on the future as we get more efficient.
Sorry, I see someone pointing.
Yeah.
Okay, great, thank you.
I was just trying to make sure the microphone was turned on. Yeah. Jens Wolf from Drax Power. I have a question. We haven't talked about regulatory risk because I think we're talking about merchant investments in subsidy-free renewables, but it's such that the grid requires quite a lot of balancing of these renewables, which is currently socialized across all users and all generators. And I wonder if for the financing of subsidy-free renewables, it's a risk that you're considering. And the second question is, what is the biggest regulatory risk if it's not that one?
I think George is our balancing flexibility market expert on the panel.
Yeah, no, well, I mean, I was going to actually bring up the question of A, regulatory risk, and B, the kind of roles of government. We've heard a lot over the course of the day on the pace of change and evolving technologies and how should those be facilitated. Firstly, on the evolving technologies, is there an ongoing role for government to provide? I think the word that we heard today a couple of times was stabilizing subsidies, which is a bit of a safety net. And if that isn't there, how are those technologies going to be moved forward? I think, Jens, on your question on regulatory risk, that is probably the number one risk on our horizon. We see the pace of technology change being rapid, but we also see the pace of regulatory change being rapid. I think from the sort of flexibility or flexible generation, what we want to see is a level playing field. I think the embedded generators have taken some serious knocks over the last couple of years, and we're looking for access to the full market, which is more difficult for the balancing market, for instance. But your point on how are renewable costs covered and socialized, then I think there's a question there as to do they filter down to consumer pricing, or is there a government role there in general taxation? So regulatory risk is our kind of number one risk going forward, and we ideally want to see access to all sectors of the market.
James, you're on the edge of your chair.
I think this is something we think about. I think doing a bit more thinking, some of the analysis would suggest that it's probably overblown, if anything. I think the need to balance the grid is clearly well known, well publicised, but I think the evidence increasingly with interconnection, with diversity of supply and different types of renewables, biomass, baseload and others, and some of the innovation that we're seeing really only just getting started, that cost is being competed away pretty rapidly, and I think the forces are only just being unleashed on that in terms of, is it priced in? To an extent it is, via the sort of cannibalization that we were talking about in Matthias's speech earlier on. I think I would totally echo George's call for sort of level playing field on that front. If we're going to have unfettered competition, then be that in all dimensions.
Yes, in the back. Thank you for putting your hand up high.
Hello, Lawrence Fumagalli from Greencoat Capital. Just to quibble slightly with Matt's maths, saying that current solar investors are implicitly taking an 8% merchant, or pricing merchant risk at 8%. I think we all talk about zero marginal cost renewables, and indeed nuclear, but we forget that there are actually ongoing OPEX costs. So if OPEX was zero for a solar plant or an onshore wind plant, and you were earning £80 per megawatt hour, and you priced half of that, the power bit, £40 per megawatt hour at 3%, at 8%, and the rock bit, £40 per megawatt hour at 3%, you might well end up at a blended 6 to 7%, and get the impression people were taking merchant risk for 8%. But onshore wind and solar have probably got OPEX of about £20 per megawatt hour. So what you're forgetting is that the rock bit of the revenue stream is taking the full pain of that OPEX. If you take that away, what you're left with is a merchant-only plant earning £40 a megawatt hour with OPEX of 20. So you've got 20 left. I think Matthias amply demonstrated you could easily lose £20 a megawatt hour through cannibalization or other effects. So no lender in their right mind would lend a penny to that plant. Certainly it's not an 8% merchant risk.
Is it a question?
I don't know.
It's an observation.
Sorry.
I think don't forget about the ongoing OPEX.
Right.
Don't confuse zero marginal cost with no OPEX.
Do you want to offer what you think the right cost of capital is?
I think it's at the moment near infinite.
Sorry.
Infinite.
Oh, infinite.
Near infinite.
Oh, sorry. That's pretty high.
Well, I will never question your maths. There's clearly lots of different ways to cut up where the OPEX lies and how to split the cost of capital between the two elements. I suppose a couple of observations there is you've got, I don't know what Greencoat's achieving on levered solar assets, but effectively you're taking out most of your ROC subsidy with the leverage, and you end up with effectively a merchant price exposure. If that is an infinite return, then that's very impressive. I suppose the other part of it is that we have got project finance on a 100% merchant solar asset in Italy. So it is possible.
Great. Any other questions from the audience? Let's see. No. Look like a. No. Okay. I have an open question. I will take the first taker for this question, which is, will we have utilities as we know it in the future? Or could we see the pendulum swing so far that their large customer bases are natural off-takers for renewable generation? Let's look into the future a little farther than Aurora does, farther than 2030. Which I always tease John is still shy of the utility investment life cycle. Anyone want to take that?
I'm happy to have sort of first crack at it. I mean, I think the slide that John actually showed first thing this morning is that we are seeing utilities go in different directions. Some are sticking with their customers and looking to focus on a supply business. Some are heading off to the generation sector. So I think utilities generally are not well prepared to participate in merchant markets. Should we want them to? I guess is we're looking at the sort of conventional wisdom of a utility rate of return is a low risk, low return, and in so doing, are you going to be able to, capital or utilize their cost of capital in going to the merchant sector? If I got what Lawrence was saying correctly, as opposed to his infinite rate of return, it was infinite cost of capital. You're sort of, in essence, you're covering your operating costs with your ROC. If you take that away, then you're not putting yourself in a position to participate in the merchant market. So I don't think that it's a slightly rambling response. I don't think generally utilities are our answer to the merchant markets.
James?
I guess I may lack imagination, but I don't see utilities evaporating. I guess I do see many challenges, and you can see that landscape continuing to evolve. So major energy users, I think, are increasingly going bilateral in their energy procurement. A lot of this isn't new. I mean, I was talking to Nina earlier, but demand-side response has become a sort of new term. But I mean, the first 10 years of my career in the steel industry, and our supply contract allowed 20 periods of load management a year, where before 9 a.m. they had to give us notice of being off for an hour or an hour and a half in the evening between November and February. So I think the large energy consumers are going to increasingly try and disintermediate the utilities there. You can see competition in different dimensions. Utilities are, the consumer is getting more and more challenging, not just the millennials and the sort of Facebook generation, but in general, expectations are rising for what we expect from our utilities. And I think even some of the incumbents themselves would admit that historically their customer service has not been all that it should have been. And so I think you can foresee industries that are very good at customer service starting to invade that territory. So I think there are some real challenges there, but equally they have some inbuilt advantages. I think there was discussion earlier that the trading arm of a utility is clearly a big advantage in increasingly merchant revenue streams. So I see continued evolution there rather than a collapse of the business model.
Yeah, but of course, across the sector, we see that utilities often don't have the lowest cost of capital. They often, incumbents in any sector often don't have the lowest cost structure. And that is something that I think, again, this is not a 5-year time horizon, but a 30-year time horizon. If we continue to move towards distributed, which I very much believe we will, I don't think that's really in dispute here. Can you see, further erosion?
So I think there's subtlety there between what people will do and what they can do. I think utilities clearly have balance sheets, so that enables them to make some bets. We've seen that with the EFR auction, for example, where one utility decided that was something they had to have, kind of, and never matter about the price almost. So I think they have the ability to apply their capital resources strategically where needed. As you say, that they are almost by nature of being the incumbents, likely to be generally defensive about protecting existing business models. But I would have thought that if you try and have the sort of King Canute strategy in this market, it's not going to be wholly successful. So I imagine that we will see them continuing to try to innovate.
But I mean, I guess question for you really is to, when you say are utilities best placed to participate in the merchant market, what do you mean by the utilities? Are you looking at utilities managing infrastructure for delivery of energy, so to speak, or are you looking at utilities as managing their supply base and looking after customers?
I guess if we take distributed to its logical conclusion, the customers will, the traditional models of scale don't necessarily apply. And in that case, over the next decades, why won't we see smaller players or Pratima's industry, for example, make significant inroads, i.e. the suppliers of the future or the generators of the future will look very different from the generators and suppliers of the past. It doesn't have to be small scale.
You know, I think you could do an analogy to another industry that went through the same transformation. If you look at the media industry, it started with three only major suppliers, and take it the analogy to coal, oil, and gas, right? You could watch a movie, you could get your media from television, or you could buy home video DVDs. And then they went through the transition of distributed forms of media, right? So now you have solar storage. Our barriers to entry went down with HD cameras. You have shale gas and fracking and all this other stuff. Very, very similar transformation, actually, that happened. And we went through, and I, in one of my strange career moves, was in the media industry for a bit. But we went through the same discussion.
Well, it wasn't strange because you worked for GE.
Yes, you do lots of strange things there. But I think what was really interesting to me, having sat in that space when every newspaper article was about my job to some extent, and I'm here again, right, is that we asked the same question. Are movie studios going to exist in the future? Is television the way it's going to work? Is peer-to-peer network sharing of media going similar to distributed? Will it replace the push out? And it ended up that, at least in that industry today, all those forms exist. The business models have changed. How you make money has changed. How you deliver the content and what type of content's available has changed. And there's a lot more consumer access. So if I draw that analogy, I'd answer that, yes, they'll be here, but what will they be doing? You know, what's their role? And it's going to be different in different countries. Just moving from the US to the UK and watching the debate is just very different. So I think that would be my answer.
Thank you. Any more questions from the audience before? Yes, in the back, before I let you get to your champagne and John's instructions.
Hi,
Thank you.
It's Harry Gibson from Augusta & Co. I had a question about how you see I think it's mainly to Matt, the depth of the corporate PPA market in Europe, and particularly sort of baseload PPAs versus as-produced PPAs, i.e. PPAs that take generation weighting sort of risk and PPAs that don't. And you know, particularly in the context of the conversations in earlier sessions about sort of putting a lower bound on cannibalization and generation weighting, you know, how important do you see that for, you know, both from the corporate perspective, but also from you know, developers and generators?
Yeah, I think it's a good question. So when we're talking about corporate PPA, because we're talking about this is an alternative to ROC, clearly we're talking about the corporate committing to 10, 15, 20 year. And in any product you're selling, getting someone to buy your product for that period of time has its challenges, particularly in an environment where there's a degree of uncertainty on energy prices over that period. So we don't know, frankly. We're building a team to try and build a product because, as I've sort of touched on before, we think the best route to, the best way to scale renewable energy, even with subsidized assets, but even more so with unsubsidized, is to look out those energy prices. My sense is that we see a much more established market in the US. There's no reason to say that those same US companies wouldn't be doing the same in the UK. And actually, as I've sort of touched on before, there becomes a bar where one supermarket chain says, actually, we're going to be 100% green in 5 years' time, therefore the next one does. Now, again, it doesn't necessarily mean they're all going to walk into a sort of a 15-year, 20-year PPA, but does it make sense that they do 5, 10, 15% of their demand on that basis? And based on the fact that we're down to the last two on a tender for 100 gigawatt hours, moving to 300 gigawatt hours, investment grade counterparty. We've got various bids like that out there at the market at the moment. Suggests there is an appetite. Now, I have no idea whether that's going to scale so that it's going to be the mass rollout of renewables in the UK to the scale we need to. My sense is that it will get us to a stage where we can get the first iteration of these unsubsidized renewables out there. And the attraction to Laurie's point about the cost of capital is that potentially, unlike the utilities, we can have a lower cost proposition for these corporates. So if I sit in front of a European or Korean pension fund, what is the thing they're worried about? They're worried about energy price risk. So we say, is it the fact that the return at whatever 6 to 7% is the problem? No, it's the energy price risk, the risk return on that level. So would they buy those same assets at 5%? Yeah, absolutely. So because then they're comparing it to Google bond plus a bit of solar or plus a bit of wind risk, and therein we can offer a corporate PPA at really quite attractive price, certainly far below where energy prices are currently, and lock that in for those corporates. So I can see there's a product really interesting, and then if you innovate on the product and make it easier for those corporates to buy, you start, to your last point, you start selling them a product which is actually based on when they're using electricity rather than when we're just generating electricity, which is our next innovation. Then you get something really interesting again, and maybe you can increase the price from that sort of entry level.
But I mean, I think there's a challenge. Clearly, if you can access a 15, 20-year PPA, then that's going to put you in a strong position to raise finance around that. But the number of counterparties out there who are willing to go much beyond 5 to 7 years is generally pretty small. So I think it's the question is access to markets. That the discussion we heard about kind of blockchain technology, looking at opening up routes to market, and the opportunity for more suppliers to come into the market. I think that's going to be a very important piece of the equation. But getting assets financed is therefore establishing confidence that after that 5 to 7 year period, if you can even access that, and what is commonplace through sort of many kind of European or evolving European countries now is some level of capacity payment, is having confidence that there is going to be a revenue stream that you can access post that. So PPA is great, but I think that the advent of 15 or 20 years PPAs, there aren't many entities that will give you that sort of length.
On that note, this concludes not only panel 5A, but also the day. Thank you very much to the panelists. I think it was good news for risk aversion today, good news for investors that you will need stability for the foreseeable future. Thanks very much. And I think John,
I have some instructions.
we're not getting away without hearing from John one more time.
Yeah, sorry. Maybe more than once, actually. But so I've got some instructions. But before that, I think really importantly, so Laurie, is little known fact, but Laurie's the first ever non-Aurora person to chair a panel at the Spring Forum. If there was any doubt when she encouraged a debate around cost of capital mathematics at 5:15 in the afternoon, it was a sign that she was doing the Aurora thing and getting into the detail. So many thanks to Laurie for brilliant chairing of that session.